One of the most important names in finance has recently shocked the investment world with his comments on the much-beloved electric vehicle company Tesla. Michael Burry, the star of the Hollywood blockbuster The Big Short, has recently stated that I live in the land of Tesla. I know what a Tesla car is. I talk to the mechanics at dealers, but being short is so much more than that. But why is Burry so convinced that Tesla will crash? Burry is considered to be an investing legend for predicting the 2008 financial crash with enough time to make himself a personal profit of a staggering $100 million and a further $700 million for the investors of his hedge fund, Scion Capital. This was a 489.33% return. It goes without saying that those who wish to make money and stay ahead of the curve pay close attention to what Michael Burry says in public. This is why it has come to the great surprise of the investment community that while many have been showering Tesla stock with praise over the last several years, Burry has expressed a significantly negative outlook on the company and the value of its stock. But just what is Burry's beef with Elon Musk exactly? Burry was not short the stock when he made the public statements about shorting Tesla stock. It is not legal to talk about a stock that you hope to see go down in value. However, he did compare what has been happening with Tesla's stock price to the dot-com bubble. Specifically, Burry is referring to the hype surrounding Tesla. Tesla mania, it appears, has not convinced everyone yet. Moreover, Burry is not bearish only on Tesla, but on the entire US equity market. Market Insider wrote, on January 23rd, he tweeted a chart showing the S&P 500's plunge during the dot-com crash, and circled in red its rally between September 2001 and March 2002, before it bottomed 6 months later. The implication was that the S&P 500's 17% rally since last October's low could also prove short-lived. Burry is one of several top commentators bracing for a catastrophe. GMO's Jeremy Grantham recently declared the S&P 500 could plummet 50% in a worst-case scenario, while Universa Investments' Mark Spinsnagel diagnosed the greatest tinderbox time bomb in financial history. Are we in a bubble? Should investors dump their equity holdings and head to safer assets like gold and government bonds? Let's remember that Burry was one of the few that saw the financial crisis coming, calling bluff on the mortgage market and the banking system. Back then, nobody wanted to believe Burry.
I tried to convince them to trade in this market with me. Initially, I found no takers. This was March of 2005. The whole effort was complicated because it was important to me that this security, this instrument that I'd like to use to short the market, would be standardized such that if I bought a credit default swap from one dealer counterparty, I could easily trade that credit default swap to another dealer counterparty. Bespoke, one-off contracts were full of contract and counterparty risk that I would not tolerate.
The investment genius of Michael Burry paid off in 2008, but is he right about Tesla? The automobile company share has so far this year been doing quite well, suggesting that investors disagree with Burry's bearish outlook. However, its price remains far below its peak, mostly because in the latter half of 2022, a period during which Elon Musk was very active in his purchase plans of Twitter, investors sold their stakes in Tesla, which was seen as a reputational risk, as was anything linked to Musk's name at the time. Moreover, Tesla recently announced price cuts for its EVs in China. As MSN reported, Tesla began cutting the price of its Model 3 and Model Y vehicles in China last October, with similar reductions unveiled in the US shortly after, and then deepened them earlier this month after the group posted disappointing December quarter delivery figures. Musk said that these cuts were based on the strong demand for the cars, meaning that Tesla would still be making a healthy profit as the increase in volumes of units sold would more than make up for the price cut. The British financial website Motley Fool did a recent analysis on this move and stressed that, to this end, CEO Elon Musk says he expects Tesla to produce around 1.8 million electric vehicles this year, up 37% from last year's 1.31 million. The analyst community is confident this expansion will eventually lead to net positive profit growth too. And let's not forget about Tesla's initial vision, a noble attempt to save the world's climate by providing less polluting vehicles. Why is this important? Because investors also care about the purpose of their investments, and Musk's vision clearly fulfills this demand for purposeful investments when it comes to Tesla at least.
There are three elements to a sustainable energy future. One is obviously sustainable energy generation, which is primarily wind and solar. There's also hydro, geothermal. I'm actually pro-nuclear, I think nuclear is fine, but it's going to be primarily solar and wind as the primary generators of energy. The second part is you need batteries to store the solar and wind energy, because the sun doesn't shine all the time, the wind doesn't blow all the time. So you need a lot of stationary battery packs. And then you need electric transport. So electric cars, electric planes, boats, and then ultimately, it's not really possible to make electric rockets, but you can make the propellant used in rockets using sustainable energy.
Right.
So ultimately, we can have a fully sustainable energy economy, and it's those three things: solar, wind, stationary battery pack, electric vehicles. So then, what are the limiting factors on progress? The limiting factor really will be battery cell production. So that's going to really be the fundamental rate driver. And then whatever the slowest element of the whole lithium-ion battery cells supply chain, from mining and the many steps of refining to ultimately creating a battery cell and putting it into a pack, that will be the limiting factor on progress towards sustainability.
However, as we have already pointed out, Burry's view on Tesla may be a proxy for his perspective on the broader US equity market. To some investors, Burry's comments seem to suggest that we are in a bubble that will inevitably burst, and when it does, the whole market would be taken down with it. In a recent note, the global asset manager GMO stated, "The first and easiest leg of the bursting of the bubble we called for a year ago is complete. The most speculative growth stocks that led the market on the way up have been crushed, and a large chunk of the total losses across markets that we expected to see a year ago have already occurred. Given the starting conditions of extraordinary speculative euphoria, this was all but certain. The negative surprises of last year, from war in Ukraine to the global inflation spike, were quite unnecessary to ensure a significant downturn. Now things get more complicated. While the most extreme froth has been wiped off the market, valuations are still nowhere near their long-term averages. Further, in the past, they have usually overcorrected to below trend as fundamentals deteriorated. Such an outcome still remains highly likely, but given the complexities of an ever-changing world, investors should have far less certainty about the timing and extent of the next leg down from here. In other words, we are in a bubble that began to correct itself, and when it will burst is uncertain. Shouldn't this warrant caution from investors? Tesla was one of the most speculative growth stocks mentioned in the GMO note. Therefore, Burry's vision of the direction of Tesla's stock price can be taken as a proxy for his worry about a bubble in the US equity market that is about to burst, taking the whole market down with it. Perhaps the burst will come from where investors expect the least, from the passive funds, which mime the market on its way up and on its way down. Take Tesla for example. If investors sell the shares in large quantities, index funds also have to sell them, putting further downwards pressure on the stock, which can quickly spill to the whole sector and then to the entire market. This was pointed out at length in a recent analysis by Seeking Alpha entitled Michael Burry, The Passive Bubble is Deflating, where this thesis is explored at length. We recommend you check out the paper. We do know that Burry publicly bet against Tesla during the pandemic and accused Musk in late 2021 of selling the automaker's stock because he knew it was hugely overvalued. The Scion asset management boss, who has predicted a stock market crash and prolonged recession lie ahead, ominously tweeted, "Sell," and deleted his Twitter profile this week. Michael Burry deleting his account every time he shorts the local bottom will never stop being funny, a Twitter user who goes by Fubar wrote this week. Musk replied with a pair of emojis crying tears of joy, suggesting he didn't take Burry's departure from the platform too seriously. Musk has previously labeled Burry a broken clock and teased him for betting against Tesla. But what about you? What do you think? Do you believe that Burry is seeing an equity bubble bursting with Tesla as the scapegoat of this event that will take down the whole US market? Or are the fears overblown? Let us know in the comments section below. Or are you too busy buying new sustainable fashion items from clothes.com? This is without a doubt the #1 home of stylish, sustainable fashion items that make the perfect gift for your loved ones. Search here for organic cotton, bamboo, hemp, and recycled plastic to browse the latest fashion trends, made in a way that is both kind to the planet and your wardrobe. Back to the equity markets. The current consensus is cautiously bullish as institutional investors begin to turn on their risk appetites. But it doesn't mean that big money is right. Remember the 2007-2008 disaster? Let us know in the comments section below what your thoughts are. If you like this video, make sure you give it a thumbs up and subscribe to this channel right now. No, seriously, stop what you're doing right now and hit the subscribe button for more premium content on finance and investing. Until next time.